Hi, everyone. Thank you for joining us today. We're here with AgriRoots Capital Management. This is one of the newest issuers on our shelf, and an industry segment that we've really loved, which is the farming and agriculture segment of the investment landscape. We're excited to do a bit of a deeper dive into the investment opportunity. We have Rob and Matt and Sean joining us from AgriRoots, and we're excited to learn about an opportunity to invest in the agricultural business. So with that, let's turn it over to the AgriRoots team and let's get a deeper dive into this great investment opportunity.
Thanks, Corey. It's always a pleasure to be chatting with folks. They're integrated with Raintree. So for those who are here today and for those who will watch this presentation later, we look forward to any other future questions that may arise. So we're giving you a little bit of a high level of who AgriRoots is. We are in the debt space only in the agricultural sector, and what we focus on is more of a consulting base, and we're a lender behind that. So we're looking at the agricultural space that unfortunately that has been left aside in the Canadian agricultural space that needs some assistance in short-term lending. So that's where we aspire to be and have grown to be. So we've been around in the industry for about 20 years in a syndicated model, but now we're in an LP trust model, which is what we're talking to you about today. Anyways, so Matt, if you can just slide back one slide for me. Okay, so the investment opportunity for you, or the returns, so that's 6.5% on a hurdle rate, plus 60% of net income over and above that hurdle rate. Early redemption is after 2 years. So basically there's no fees after 2 years. So it's a very short-term space to be in. We try to match all of our investments based on the term of our mortgages. That's why it sits at that space. We're matching our liquidity. If you can go to the next two. And so here's a bit of a snapshot of some of the mortgages we have. So in Alberta, we have one that sits at 1.68 million. First mortgage, 50% loan to value. And this is a pretty common number that we see in our fund. Our average fund size, fund mortgage is 1.5 million with a loan to value of 55%. So on arable land, and we'll get in a little bit more on that now in some of the next slides. But these are all typical deal sizes. We are across the country in most provinces now, just not quite into Quebec yet, but that'll be in the future. So AgriRoots, a little bit of history of AgriRoots and who the team is and what we do. So we're the first national alternative in the agricultural space, which the agricultural space right now is derived of a whole bunch of private lenders, some co-ops that are lending in this space. The market size right now is $11.9 billion as recorded in StatsCan CRA's May of 2021. So it's a very large market segment being serviced in a very fragmented way. So there's the need is there. The organizational standards need to grow, and that's where we come in, and we'll talk a little bit about ESG a little bit later and to understand that space. So we founded a team in 2019 that had alternative lending backgrounds, agricultural backgrounds, and investment industry backgrounds. So we put the best of all worlds together to support the agricultural network across Canada and to maintain the food supply chain. It's very important to us to make sure we understand that the food supply chain is number one in Canada, and there's a big part of Canada that needed some assistance here. So that's where we are well positioned. What we do, temporary financial aberrations that'll happen with farmers, and that's due to commodity prices, it's due to Mother Nature, it's due to mismanagement. There's a succession planning that also caused some needs for us, food chain security, and finding the right exit strategy for the borrower. So here's some of the things that we really strive on. So Sean will talk a little bit further. Sean manages, is our president and manages all the credit side. What Sean does is that him and his team, when they're looking at files, they're clearly looking at exit strategies for the borrower. So we're here as a consultant first, which is a very unique position to have as a lender. Yes, we do lend money, but we look at it as a business modeling, consulting. How can we, the farmer that is in need of cash, help them with their business models, help them with the proper exit strategies. And the exit strategy to us is getting to a financial institution, a credit union, Farm Credit Canada. And sometimes it's a sale of a property, but whatever the best position is for the client. So that's, and Sean will touch more on that as we move. You can go to the next. Here's our team. And I'll just give a high level of everybody. So myself, my background is in private debt. I've been private debt and agricultural for over 20 years now, and also in the residential and commercial space. So I've always been in private debt and some other business interests. So I bring a lot of business background and growth of how do you grow a business and managing businesses out. Sean and I have worked together for 17 years. Sean's background was started with BMO in commercial agricultural accounts 6-7 years ago. Sean is an active farmer. Yeah, he does run his farms. We do hear about his stray sheep there and our stray lambs that have jumped in his pool every now and then. So there's they say we're very active in the space, so we understand the space. And Sean went from BMO to Nesbitt Burns, worked as an advisor for 7 years, and then went on to the credit union sector, and that's where Sean and I met 17 years ago. And Sean and I did a lot of this lending through an AB piece for many years, and then we started talking 12 years ago, really, of how to form AgriRoots. So this has been a long-term play. And this is not something that we just decided to do overnight. We've been working and focused on AgriRoots, how we help the agricultural community for many years. Matt and I have worked together for almost 30 years, off and on, in different projects. Matt manages all of our investor relations and operations. He's also one of the co-founders and has been with us now 3 years. Sabrin, Tom's best known as the CEO of Polar Financial, a very large Canadian hedge fund. Helps us on a weekly basis of the infrastructure and how we structured AgriRoots. Tom manages close to $9 billion now inside the Polar organization. Jean-Marie Laprise, another co-founder, one of Canada's largest private agricultural farming companies. Large, if you eat Brussels sprouts, it's a 10 in 10 chance it came from Jean's farm. He produces most of the Brussels sprouts for all for Canada, and a lot for the U.S. So that's kind of his claim to fame. But a very active, astute business person. And Jean and I have been active in other business ventures and in the agricultural lending markets for 15 years together. So we've got a lot of depth, a lot of experience that has come together. Claude Robillard, one of our directors, he's worked in private wealth, managed funds across North America, Hong Kong, other parts of Asia, sits on the UN in some charitable parts, but also in some financial parts. He's an advisor to CIBC. Just a wealth of knowledge, a lot of depth. John Cowan, one of our advisory boards, and the Thompson family hybrid seeds, one of the world's most renowned person in hybrid seeds. Don Belovich, Securities, Mergers, Acquisitions, a partner at Steichman's, and Scott McKinley, who is just an amazing soul. Scott has been around for 45 years, retired CPA, personal friend of ours, but worked at Farm Credit Canada in all the coaching and underwriting and standards of practice, both at Farm Credit Canada and CIBC, and then recently worked with Sean over at a credit union. So again, a wealth of knowledge. When you're underwriting these deals, there's so much knowledge that you need, because in the agricultural sector, there could be 90 different business opportunities. We'll see on an annualized basis. There's that many different commodities and opportunities, but you need to have a lot of knowledge behind the scenes. And there's a much bigger team behind this. So we're happy that we've built a strong foundation of people, infrastructure, and technology in order to expand our operation. Matt, if we could go to the next slide. These are some of our partners that are behind the scenes with AgriRoots. Our auditing firm is PricewaterhouseCoopers. Stikeman Elliott is our law firm that we work with for all of our OMs and LPs. Belco is our EMD. Matt is licensed through Belco as our EMD. Pinnacle is our fund service company that we utilize for all reporting. Now we also have added SGGG onto our platform for fund serve. Family lending, which is our mortgage brokerage, because in our world you need both a mortgage brokerage and a lender. So family lending is part of our group and is licensed in all provinces except for Quebec to manage the communication and all the disclosures with the client. And then Computer Share is one of our investment arms, but now is, I guess, all going into Olympia Trust. We just added Olympia Trust recently, so they're not on here yet, but we will add them. So now I guess it will be removing Computer Share. We'll find out what the new name is, because this all happened a few hours ago, and we'll find out who that is. So again, a very dynamic, robust group. We've picked what we feel are and affiliated ourselves with some of the best in the industry to make sure that everything flows smoothly. ESG. ESG is the foundation of who we are and what we do. There's a lot of talk about ESG. There's a lot of buzzwords about ESG. We feel that we do meet all of the standards of ESG, and I believe it was well written in the documentation that was sent out for today's meeting. But kind of who we are, again, I'm not going to re-highlight that we're Canada's first alternative lender. But in the environmental side, here's what we're doing. We're supporting good land stewardship through supporting the agricultural sector. We're making sure that the farmers have the ability and the capital to basically make good, sound investments back into their land. They're in best practices. They're leaving the land in better shape annually than when they started. Most of these families that we deal with, is 98% of the families or the clients that we deal with are family farms and or small corporations that own family farms. And these people have owned these for 3 to 4 or 5 generations. They want to take care of them. We've seen some corporations that buying up land and unfortunately maybe not being as strong stewards of the land, because they need strong returns out of the land quicker than maybe what the families that we deal with want to do. So environmental is a very strong part of our focus. Social, maintaining food supply, supporting farming families across the country. The social impact here is extremely strong, because the farmers don't really know if they've got the credit union or bank or farm credit maybe have called their loan due to their covenants not being met. They need a safe place to go, and that's where they land with us with AgriRoots, because we have the investment background, the knowledge in the agricultural sector, and we only have one focus, and that's to get them back to mainstream lending as efficiently and safe as possible, and most cost efficient way. Right now, if they don't fit in the standard box of credit unions, banks, or Farm Credit Canada, the market is completely fragmented. They don't know where to go. So they've got to go, bang on doors, neighbors' doors, to accountants, to lawyers, to wherever else they can find private debt. And that private debt also comes at a cost. So there's lots of pure equity lenders that will lend them money, but not support them. And that's our model is giving the true support. And that's where it leads into the government side of things. I've seen for years across the country where there's been no governance on the alternative lender space in the ags. There's all kinds of governance in residential, mix, and in commercial lending. There's all kinds of lenders in that space, in the alternative space. But unfortunately, there just hasn't been in the agricultural space because it's a very unique industry, markets, and it takes a lot of skill sets to understand it. So we're bringing that governance across Canada to make sure that the Canadian farmer is well protected and that we're providing them with a value-added service with our consultations and business backgrounds that we all have in this sector in order to improve what their financial outcomes will be. Go on to the next one, Matt. Market size. We touched on this a minute ago. Total debt in Canada right now, and this is all on StatsCan's website, $615 billion in total real estate value. And why that's so important, there's only $122 billion in long-term debt. It is an extremely rich asset class with just a little bit less than 20% of total debt on the whole asset class, which makes it that if there's a real dilemma, I'm going to say that the farmer unfortunately has to sell their. It's usually the farmer next door, the abutting farmer that buys the land, and that those transactions happen within hours that we see in most cases. If a farm's listed on MLS, usually there's some problems with it. It's A, overpriced, or B, it's the outputs values aren't matching what the retail price of what they're asking for. So we can tell, and just some experience that our underwriting department knows, just simple little things like that we understand in this space. But really what it is, a very, very safe asset class. Everything has risk. There's no question. There's risk in all asset classes, but we feel it gives us a very safe space for all investors to be in as part of their portfolio. The average, as I say, the average debt to equity ratio is 20%. Family farms, we've represented 98% of all agricultural enterprises in Canada. So that's crucial. We want to maintain those numbers. The only way to maintain those numbers is that when farmers need our debt, which is about 20% of farm operations could utilize our type of debt that we offer annualized, that they come to that again provides that safety, provides the knowledge base, brain trust that is required in this space. Go to the next one, please.
Just a little bit about underwriting, and I think this is an important piece, and it's one that I'm personally passionate about. It can go on for a very long time and bore everyone, but we just like to highlight and emphasize the fact that we really do approach it conventionally. So in other words, we look at all the financial information and data that any tier one lender will or would in any lending situation. We do that for a couple of reasons. Number one, we want to make sure when we enter a transaction, we're entering a transaction where we can help someone. That's really important in our thesis, is that we're helping during that transition. And the second aspect to that is it builds our exit plans, but as importantly, they're tied to the exit strategy, is we're preparing our borrowers to get back into for the first time conventional lending institutions. So they have to have the reporting mechanisms in place, and that's the governance piece that again Rob had alluded to earlier in their presentation. That's really critical. These are big businesses, they're big dollars. And what we have found over time is the business operators tend to be very good farmers. They do lack from time to time on the financial management side of things, the reporting and record keeping, cash flow projections, commodity pricing. So those are all parts of the business. Going back to the consulting, again, that Rob alluded to earlier, that's a big part of what we do, is we do a real deep dive and really assist and position and prepare the operators that we work with for success moving forward. just really high level, just touch on this slide, from an underwriting perspective, there's really kind of four core elements. Equity and security is important, but more importantly is that viable business plan. And then when you dig back, as you want to really understand, we want to understand management's ability to execute on that plan. And then the fourth component would be the exit strategy. And I know we've talked about that a number of times during this presentation, but it's really critical, and it's at the cornerstone of our process. We do not get into a deal without a clear, predetermined exit strategy that everyone is in agreement to. That being said, absolutely, there's situations that arise that are outside of our control or outside of our, I guess, initial analysis that we deal with. We are very experienced in workouts. We really have the time, the energy, and frankly, the equity in our deals to be diligent, but yet patient enough that we can work through most of any situations in a very favorable fashion so that, everyone can win in the transaction. And that, again, is from an ethos perspective, is really important to us, is creating win-win situations with all of our stakeholders, the borrowers for sure being an important part of that stakeholder group. I don't know, Matt, if you want to touch on the portfolio.
Yeah, so I mean, going into all the practices that Sean and Rob alluded to, I mean, obviously focusing on the ag sector, and then through a true in-depth review of every file and underwriting, getting them into our portfolio. The mortgages that are within this portfolio, 95% of them are on a 12-month or less period, in order to be able to be reviewed every 12 months and assessed and follow up on their exit strategy to make sure that we're in the proper position and they're moving accordingly. But AgriRoots Capital Management started in August of 2019. Currently on our main LP and fund, in addition to a small side fund that we have, we manage just south of $60 million in the main fund. There is currently, these numbers are continuing to grow. We're just almost at $45 million. Weighted average loan to value in the portfolio is 56%. Now, again, we believe that's a very strategic position to be, ensuring that there's quite a bit of equity in the portfolio. However, when we take a look at our loan to value proposition, it's on arable land and multi-use buildings for farming. We do take security on additional assets that the farm or farm corporation has, but when we calculate our loan to value position, it is truly on arable land and multi-purpose facilities on the farm. Weighted average gross yield, so the weighted average interest rate within the portfolio across the 29 mortgages that we currently have, is 10.23%. Again, I'm sure you can appreciate an interest rate of, on an average of 10.23% is an interest rate that we are here to be a bridge lender and transition our clients back to mainstream lending, and not have them continue to sit in a portfolio or sit within a loan that has an interest rate at 10%. Average mortgage size is just south of 1.4 million. And the reason behind that is the fact that we continue to grow in a controlled and steady base. We won't allow any one mortgage within our portfolio to be greater than 10% of AUM. So as our portfolio continues to, the average mortgage size will continue to increase, but it'll be based on a function of certain limits within the fund. You can see over the last 12 months, the A-class units, we just started bringing in the A-class units for rain tree specific. But you can see what our past performance has been over the last 12 months. And we are, if you take a look at the right side of the screen, obviously we look to being diversified across the country and also across the different sectors in agriculture in order to make sure that we're doing our best to be able to protect the. You will continue to see changes based on east or west or in the different sectors, and it will be based on short-term need. So if there are situations such as, you know, floods in BC or droughts in the west, that may transition the portfolio for short periods of time, because we need to be able to be there to aid our borrowers and clients during their short-term needs when they're falling out of covenants with their current lending institution. So it will shift based on different anomalies in their operations, but that is planned. The specific, we are, again, a diversified portfolio, first and second mortgages. 100% of our assets is devoted to our niche in the agricultural sector. You know, we truly believe that it's underserviced, disjointed, and that's where our strengths lie. And we believe that it's a relatively safe asset class for our investors to be focused in providing debt for. The target distributions, so you can contact your Raintree representative for investment into A-class units. A-class units, as Rob mentioned previously, is a 6.5% hurdle rate, plus 60% of net income in excess of the hurdle rate. At this point, Sean, did you want to go into maybe a story of one of our mortgages, or just maybe how we may directly impact on a one individual basis? Or
Sure, that'd be great, Matt. And I think it's good to point out that we very much are, I guess, cooperative, and we work with other financial institutions. So we get referrals on a regular basis from Farm Credit Canada, the banks, the credit unions. And the reason we do that is we're not competing in the space that they're competing in. We're really complementary in that we can help facilitate and help transition clients from current state to a state in which the traditional FI can facilitate or fulfill their needs. So a recent example is a farm in Northern Ontario that we're just actually closing the transaction on December 20th, so a week from this past Monday. And the long story short of it is the financial institution that this farm operation currently deals with has made the decision regionally to exit agriculture in the most part. So they're keeping some files, but they're exiting agricultural lending, and it's really from a lack of expertise in the local geographic area. And that's what's caused or created the opportunity for us. So it's a large diversified farm operation. You know, financials have been strong. They've had a few hiccups related to their supply chain that's really outside of their control. Well, not completely outside of their control. And it's a very long, complicated story, but it's a good example of where we've been able to come in, and we will refinance this operation. Will provide them the necessary working capital, and our clear expectations is within 18 months, at most 24 months, is a matter, they're going to transition to a bank. And as a matter of fact, the banker that's looking at it has reached out and referred another deal to us. So a competing bank is looking at it a little too early in the process, and they weren't able to turn it around quick enough where we can act very nimbly and quickly. But again, that banker from a competing bank has referred a neighbor that could use our services as well. So it's I know I didn't dig in too deep into the opportunity. It would take longer than I could have your attention, but it's just an example of how we can work cooperatively and move quick in a situation that makes sense and is really mutually beneficial, and help transition and provide that bridge financing to a conventional lender that will be a long-term financial partner for our current client.
All right, Corey, did you? I don't know in this format whether there's a Q&A or if there was a chat room or anything like that. Just not.
Yeah, we can do a little bit of Q&A. If any of the attendees have any questions, feel free to type them into the Q&A box. I have a couple of questions that I'd like to go through. So for one, you've talked a little bit about kind of why you like the family farm space for lending. I just wanted to go through an example here related to a risk that a few investors might identify, and that is, like, for instance, the cash cropping segment. If a farm is working all year to plant a crop and they get to the end of the year, whether there's a drought or any other issues, can that sort of climate risk or individual drought risk, can that impact the farm's operation? Or is there, I believe I've heard of some crop insurance that a lot of farms will get. Is that something that's mandatory? And how would that help kind of alleviate some of the farming risks that we would think of, like droughts, or maybe in different avenues of the farm, of something happening with some of the animals or anything like that? Can you kind of speak to a little bit of that?
That's a great question, Corey, and I'll jump in and others can jump in as well. But that's, I guess, one of the interesting things about this business sector is that very thing is production insurance is available. Now it's not mandatory as far as the farmers have to participate in it. For us, from a lending perspective, probably 9.99% of the time we will, or 9 times out of 10, we will mandate it. And it really comes down to cash flow and how concentrated their business risk is. So if everything is 100% dependent on weather based on a cash crop operation, then yes, crop insurance would be a mandatory component of the package. If it's more diversified and they have some off-farm income, it's possible that we wouldn't mandate it, but highly unlikely. So it is an interesting attribute to the farm business, is that kind of production insurance is available. The other kind of key risk, mitigant would be is just federal and provincial government support of agricultural industries generally. And that's not specific to Canada or any province. The US, the EU, most developed countries are very, very supportive of agriculture for all the reasons that we can think of, and aligns with our own personal needs. That food supply chain, countries that were hungry, in previous world wars have never forgotten that, and the developed world has been very diligent to make sure they support agriculture generally, which provides a bit of a put, if you want to call it, under the ag market, in that there's revenue and production mitigants that help support the industry. Those short-term aberrations will be what creates opportunities for us, I guess. And the last thing I will suggest is crop insurance, while it's very important to have in place, typically will cover costs and then a little bit. It's not a replacement. It's not an income replacement. So in other words, the profit won't be embedded in that insurance. And again, most of us have always looked at insurance as protection, not a profit stream. And that is very much true in crop and livestock production insurance.
Thank you. That gives us a good context. And one of the other things I was curious about, I've heard of some of the farmers kind of selling their product a little bit in advance. I thought this tied in a bit to the futures market, but like would everybody, would a farm, like say they want to plant soybeans, like would they make that decision in the spring, plant everything, and then at harvest kind of see what the price is? Or could you speak to kind of the mechanics of how that would?
Typically, at least a portion of the annual production would be forward contracted. So, I mean, it's a futures type derivative that is available in every grain elevator and livestock producers as well. So I would suggest the average producer, or at least that we deal with, that would forward contract somewhere in the neighborhood of 50 to 60% of their anticipated production levels. You know, some will contract up to their guaranteed production level through crop insurance. And then beyond that, we'll leave some crop open to be priced in the spot market at time of harvest, because it's impossible to forecast at time of planting, you know, what the yields will be and the total value of crop that can be produced. But I would say the majority are using at minimum forward contracts as a bit of a hedging and pricing mechanism. You know, certainly some producers, more sophisticated, larger producers, will use different hedging techniques like puts and calls. You know, not all that exotic, but you know, for some of these operations, that is pretty exotic ways of doing it. But yeah, hopefully I answered your question.
Yeah, it just speaks to kind of the revenue a little bit of these farms. Like it's not just kind of what people might think of. You plant a crop and you see how much you get, and then you sell, and then you try and sell it at that point, where there's a little bit more certainty if you're planting in the spring as to what that kind of revenue is, and some of it is kind of already sold in those futures contracts, as you mentioned, and insured up to a certain level of production. So there is there's some revenue certainty, at least to a certain extent, and that would help a lot with a farm in their planning, but also with you assessing kind of and doing your own due diligence on these farms of like how much money, like revenue, is kind of already sold or contracted in, even if there's some issues with the crops or the farm, like how much is covered in insurance, and that gives you kind of a lot more certainty than some other lending strategies. Kind of like, I mean, one of the risks to lending on a house might be fire, but if you have fire insurance, that risk is covered off, and I don't think anybody lends without fire insurance on a property. So it does help as some of the risk mitigation factors. I haven't seen any questions come in though, so I wanted to just thank you very much for coming in and speaking to us today. That was a great presentation, and it's really good to get a better perspective on your fund, and I really appreciate your answers to the questions and kind of peeling back the onion a little bit so we could understand the farmland business and the lending opportunity that comes along with it. So thank you very much.
Very good. Thanks, Corey. We thank everybody for joining today, and those of you who are going to intend to watch it later. And we're always here to support everybody at Raintree, and any questions that you may have, or if you need us to be involved in any investor meetings, we're certainly here to assist. Appreciate it.